Okay, now we're going to get into some of the nitty gritty. What do we look at? Number one, again, I'm going to hit it again, cash flow. And that's real simple and basic, but it's important. So I'm going to keep drilling that. Net NOI details. NOI stands for net operating income. The details around that. What does that mean? When we're doing an evaluation, like Andy and I are working on a deal right now, 20 years. When we're working on a deal together as brokers for clients or as investors, when we're doing our due diligence, we're really seeing what that net operating income is and what are all the details that might affect that, right? How do we get there? And then what are the things that are going to affect that going forward? Because that's the lifeblood of your value and your cash flow, right? Also, we look at price as it relates to cap rate. By the way, we were talking about out-of-state property. The good thing about when you roll out of state, especially, here's a great strategy. A lot of people were successful at it. Taking their California gain, bought a house. I have a client, sold him a couple of houses, sold a couple of his houses in Pittsburgh, California. He rolled them out to Ohio. He bought 3 apartment buildings. So he was able to take his big-time gain in California, roll that into units out of state, right? If you do it right, you can make a ton of money like that. California has a lot. Our cap rates, and I'll talk about what that is, are lower because our real estate, our values are higher. Our market appreciates more. There's less inventory. There's more money. It's more of a stable economy. So your cash flow, your cap rate is going to be lower. You go out of state, it's going to be a little bit higher. So the price as it relates to the cap rate is what we're looking at. 2 other things, and there's more than this, but these are the main things. Rent roll. This is going to tell you what your tenants are, how much they pay, what units they're in, move out dates, all that stuff. This is critical. And that's the same for an apartment building, also for office, retail, whatever. Then another thing, cash on cash return. This is the measure of your cash flow as a percentage. I'll talk about what that is. Very, very critical. And a lot of what I'm talking about is not even going to include appreciation. Appreciation, the growth of the value of the property, look at that as an added benefit because you don't control it. You can do some things to increase the income of your property, thus increase the value, but you don't control the market or the outside. So why even bother about it? Just focus on the things that you can influence and or control, right? Okay, so when we're evaluating property, which is important, when you're an investor, make sure you do your due diligence. When you're an agent or a broker representing an investor, you got a responsibility to do that due diligence for them. So whatever, if you're a mortgage broker or a mortgage professional, you got to do your due diligence for your bank, also for your client. This is critical. In apartment buildings, it all starts with the income. That's where we start from, right? When we look at it, we're creating a profit and loss statement, or we're evaluating a profit and loss statement. First thing we look at is the income, right? That starts with what's called the growth schedule rents. That's the total amount of rental income you would achieve if all the units were rented out and everybody was paying. It's another story, right? Now, you start taking away from that, right? So you're going to take away what's called vacancy. And that's pretty self-explanatory. When a unit is vacant, it's vacancy. Now, what you're also going to take away from it, now this is what a lot of us miss, is what's called loss to lease and or concessions. Also, delinquency, people not paying their rent. But in the software market, let's say the economy goes down. Sometimes, when I was in Ohio, I was doing deals in Ohio when the market crashed. And we had to give people, on certain properties, we were giving people 2 months free. So you sign up a year lease with us, you get your first month free, and you get your last month free. All you got to do is put that in your deposit. That was a pretty good deal. We was able to get tenants that way. Even in Oakland, sometimes people was giving, what was popular, I remember, $99 deposits, and they were first month free. That's a rental concession. A couple years ago, even into last year, people in Stockton and Sacramento, that was very prevalent. Although now, markets got a lot better. There's not too much of that even in Stockton and Sacramento anymore. A lot of the rental concessions have burned off, okay? Delinquencies are something that we all going to have to deal with. As landlords, as brokers, or as property managers, sometimes people not going to be able to pay their rent. They lose a job, or they're just hustling, trying to get over it, or somebody dies, and whatever happens, sometimes people just can't pay. So, it happens, yeah. So, professional totes. Jason, you had a question?
What is downstream and multi-family historically watch for as apartment complexes? Or as the price is going down or cash flow going down, historically have you seen a lot?
Well, it was just like the last market fall. It wasn't necessarily apartments, but it was the whole financial. It was the whole financial system, I think. You know, right? I remember. I can give you an example. I was in contract to sell a building in Ohio. I had a buyer from California. We were from California, so we all got on a plane. We went up to Ohio. We were in contract. Me and my business partner we was excited because we was in contract to sell a building. We were going to make a nice profit. We had renovated this building halfway, well, all the way across the country. This was October 2008. This was a weekend. We got back on Sunday night.
Totally different.
That Monday, stock market dropped 707. What was it?
Over 7 points.
777 points in one day.
Yeah.
He called me about 4 o'clock. That's whenever they stopped trading. 4 o'clock East Coast time. I can't buy the building. I don't know what I'm doing. I'm about to take a vacation. That's what he told me.
Wow.
So our contract was gone. Now, at that point in time, the real estate market, the commercial market hadn't crashed yet. The residential market was starting to slide. When that day happened, that was the stock market. It wasn't even real estate. But see, everything's all connected.
Domino.
You know what I mean? It's all connected now. So AIG's talk about we're going out. Nobody's gonna have insurance. You know, the sky is falling. So he called. I can't do it. I don't know what I'm doing. I'm going on vacation. And that was October. For the rest of that year, I didn't close. No, actually, I closed one deal. I closed one deal in November. And I think my entire brokerage, I was at Sotheby's at the time. I don't think any. There was maybe less than probably about, and we had between two offices about 100 agents. But there's about 3 or 4 properties that got sold from October to in December. The market stopped. Market shut down. Yeah. The only thing we was excited about when Obama got in there, we was juiced everything. It's a new day. It's a new day. But I mean, really, it's shut down. And that wasn't even like the real estate market. It was the financial world. Everything is connected, right? And so when the insurance company's about to go out of business, bankers get cold feet. The stock market dropped 777 points. Everybody's losing money. Even if you're not invested in stocks, maybe your bank is, or maybe your insurance. Somebody that you're involved in just lost a bunch of money. So everything shut down. Yeah.
Well, just to show you how bad it was, for the first time in history, the federal government started insuring money market mutual funds. Right, they increased the FDIC insurance to $200,000. And that keep from having to run on the banks.
Right, because people were going to the banks, pulling out cash, panicking. So it's really just the financial markets. You know what I'm saying? As opposed to apartments. Now, in the past, in traditional times, apartments have gone down. Like, for instance, there was a lull in apartment building growth and occupancies in the early 2000s. When after the dot-com bust happened and interest rates went real low, that was kind of the beginning of the real estate boom. So everybody was buying property, right? And so I was living in San Jose at that time, and everybody, 2002, 2003, people were able to get these low interest rate mortgages, so everybody was buying. That was the start of the run up in real estate, right? So apartment buildings were a little bit shaky. Well, they had more vacancy than usual. Because people could buy. People could say, hey, I'll make $100,000 on a piece of paper, and therefore I can go buy $500,000 house on a piece of paper. That was part of our problem, right? But at that point in time, apartment buildings fundamentals lagged a little bit. But they still were performing. We never hit crazy occupancy rates of 50% like in other product classes. So in a regular market, that's maybe what would slow apartment buildings down. In the last crash, it was more of a whole financial system that affected everything, right? But even that being said, the underlying principle is that people need to live somewhere. And when credit's bad, and when you're not able to get people with credit has been turned bad, and then the banks aren't giving you money anyway, you can't go out and buy. So you got to live somewhere. So that's why apartment buildings really get well. Now, when we're looking at apartment buildings, you got to start with the income, right? That's what I'm saying. We're looking at this income. We talked about delinquency, and that's a little bit what you deal with in a tough time. What you deal with. When we were doing in Ohio, we were working with people. We were doing payment plans, and it got difficult, but we kind of worked our way through it. So you take those things away from the rents, but then what you add to it is what's called other income. If you got a big enough building, you're going to have laundry, And we're just talking about, we got a fourplex, and one of our tenants is using our laundry room as her own personal laundry room. We're going to stop that. Because we need to get our money, right? Also, you can get, if the building is big enough, you can have vending machines. You can also have billboards. You see, like the building next door, they got a billboard on it. Well, that ain't for free. They're getting a check every month for that. So that's other income that you can generate outside of your rental income. Right? So you take away from the gross schedule rent, your vacancy, your concessions, and then you add to it with your other income that gets you a bottom income line number called effective gross. That's what you actually bring in. So you actually collect. All right? Now, here's the magic, y'all. We got to start taking away from this income with hard dollar figures. And this is where a lot of investors went wrong and go wrong. And even if you're a seasoned professional, you really got to watch this stuff with a fine-tooth comb, right? Operating expenses. Not your mortgage payment, operating expenses. What it takes to operate the building, right? This is an acronym that's typical in the business called TIMR. Taxes, insurance, management, maintenance, utilities, repairs, and reserves. Right? You got a budget for that too. Pipe bust. We just had the hot water heater. Hot water heater go wrong. You got to be ready for that stuff, right?
It's coming.
It happens. You know, it's not all Pollyanna. You know, things happen. So these are the critical line items that you must budget for. The way you get to evaluating what your costs are going to be in the future is you look at the past. History has a funny way of repeating itself. So what do we want to do? We want to look at the last 2 to 3 years of the profit and loss statement from the seller. If we're refinancing, if you're a mortgage guy, it's going to be the borrower. But you want to look at the history, the financial history, because that's your best indicator of what's going to happen in the future. Right? What does the last 2 to 3 years look like from an income and expense standpoint, right? And you want to look at property taxes, not necessarily what they were, but they're going to be, right? Every city, every county is a little bit different. So you need to look. In California, it's mainly based on the purchase price, 1% plus all the local assessments, right? When I'm dealing in East Oakland, Deep East Oakland, we got a high tax rate. I don't know where the money goes, but we got a high tax rate. Almost about 1.9% of the purchase price. Because we got something called a violence tax in 94605. If you own a property in Deep East Oakland, 94605 zip code, 94603 zip code, 94621, you pay a violence tax. Because we got the violence in East Oakland. Right. And then there's all these other what they call special assessments. In my neighborhood, this is called, these guys don't know, this neighborhood on Telegraph from 20th Street to 34th Street is a new neighborhood as of 2012. It's called the Kono District. That stands for Koreatown Northgate. So you're in Kono right now. A lot of people think it's uptown. We're not uptown technically. This is a special assessment area. It's called Kono. Management, just know there's on-site management and there's off-site management. If you're going to hire somebody, if it's over 16 units, in California, you have to have somebody living. And other states, in Ohio, I think it's 20 units. In Texas, I don't know what the unit limit is, but every state's a little bit different. But when you have large apartments, there needs to be somebody living there. Usually by law, but also by functionality. Fire, gas leak, whatever. There's got to be somebody there who can instantly call the cops, paramedics, or somebody, firemen, to come out and deal with the issue. Also, you want to have that on-site presence. That's critical. But when you pay management, and it's a bigger building, you're paying 2 line items. You're paying for the company. That's going to be a fee, and then you're going to pay for the on-site and their compensation. Usually that's going to be a free apartment plus some perks. But just know that. Then you got maintenance. Don't forget about this. This is the biggest thing that people miss. Somebody moves out, you got to turn that unit. Somebody's toilet goes bad. You may not have to get in there and do it, but you got to pay somebody to, right? So these are things you got to budget. See what the seller has been spending, and then kind of budget that into the future going forward. Utilities. This is a big one, y'all. Gas and electric kind of remaining steady, although they're always going up. The big one's water. Big one's water, right?
Big time.
If you got a building where tenants are paying water, like we got on Wadeen, you're doing good. Because you've now offset that cost to the tenant. And when tenant is paying for water, believe me, they become real conservative. When you pay for the water, they take a shower, they letting the faucet run, and and they're gonna start finding people. You know, if they see
Find
you.
people on the ALS challenge now in California.
I heard about that. Yeah.
You find people who's looking for water.
Well, if you're watering your lawn and the city or somebody, I don't know who these people out there telling you you're not supposed to be watering your lawn now. I think you're supposed to water your lawn at like midnight or something. I don't know. But you gotta watch out for your utility costs. They don't stay flat; they go up, and we're in a drought. So I expect water to go up. You find a building where tenants are paying water, that makes that building more valuable. Not a lot of them though. Not a lot of buildings.
Who determines who pays the water?
What's that again?
Who determines who pays the water bill?
Well, it's like this.
One water heater.
It really depends on the setup of the building.
Oh, I see.
If you got individual water heaters and water meters,
Yes, yeah.
you're going to pass that to the tenant.
So you
A
can't-
lot of buildings don't have that,
No,
right? Most of them don't.
That's
See, for a case on, with the water heater that broke,
Mhm.
one tenant is occupying the washer and dryer there. Is there a common, are you paying water for a common area?
Yeah, and so we are.
Okay.
And in a common area, you're always going to pay. The landlord's always going to pay. And that situation needs to be changed because we have a tenant who's using the laundry room for our own personal laundry. But we need to make some upgrades to the room in order for us to be able to achieve that.